putting some money in there, and that's the money you're then looking to invest with. So
Pips.
this is a good time to ask the question, how much are you looking to trade with in your trading
Pips
account?
are the last two
Let's just drop
digits.
some answers in the box. Now this will be different, you'll all be there'll be some variance on those for sure. Let's read some of these out. £5,000 to begin with, £50,000, £1,000, 25k, £2,000 to begin with, 20,000, 80,000, between 5 to 25, Ian, okay, 10,000 euros, £100,000, Miriam, £2,500, $7,000, $45,000, £1,000, £1,500, 5,000 euros, $10,000, Jamie, £50,000, £80,000, 75,000, 23, quite a specific number there, £23,000, £2,000 to begin with, and then if it goes up, you can make, for example, £10 per pip, so that's £400. Now, by the way, how many of you would actually like to be shown exactly how to actually place trades? Well, that's getting a lot. That's getting a lot of yeses. Because I remember speaking to a family friend about trading. I was going through some various trading technical concepts. He was like, "That makes sense, but when I'm in front of the computer, what button do I actually press on the screen?" And I forget sometimes people need to be shown not just to trade, but how to actually use the system and navigate it around it as well. So, yeah, we're going to do everything with you. Yes, absolutely, because it means our skill set is recession-proof. It doesn't matter what happens out there in the economy, because our skill set is unaffected, which I think is very useful for a lot of people in this country right now. Earlier on, I asked you to write down why you want to trade. And I noticed people put a lot more financial security and a lot more stability, especially right now, because, you know, how is the British economy doing right now? Some animated results. Yeah, not that great, not great at all. And a lot of people are getting quite
So when the pound is going up, the dollar is going down. So you would buy the pounds. But when the pound's going down, that means the US dollar is going up. So you would buy the US dollar. When one's going down, the other's going up. So when the pound's going up, that means the dollar's going down. In that case, you would buy the pound. When the pound starts to go down, it means the dollar's going up. Then you would buy the US dollar. When the pound's going down, it means the US dollar's going up. So in that case, when the pound's going down, the US dollar's going up, you would buy US dollars. Basically. People want to have that green. It's gone down on Tuesday, hence why it's red. Now, how would we use this information to help us predict what's going to happen next? Well, look, let me show you. Now, let's say you see the euro dollar go up on Monday. Now, if you saw that happen, you might think, oh, that's interesting. It's going up. You might see it go up on Tuesday. You might also see it go up on Wednesday. Now, when someone sees this kind of thing happen, they're thinking the euro's going up. That must mean people are buying it. Now, if everyone else is buying the euro, maybe I should too. And that's where that herd psychology begins. And most people look for that social proof before they enter a trade. If all my friends are buying shares in Tesla, maybe I should too. Well, now, if they see it go up again on Thursday, it just reinforces that belief. They start thinking, you know what? I had a feeling inside me that it's going to go up on Thursday, and it has done. So I might as well get in. And I think that's an important distinction, because that's what's up. However, though, by the end of the day, where that closing bar is, the sellers brought it all the way back down. So really, the sellers won. So on Thursday, the price remains green by the sellers who are pushing price back down by the end of the day, despite it being a green bar. So the sellers have kind of won, but it's still effectively a green bar because it opened a little bit lower than where it ended up closing. It's still a green bar. So which way do you think the price could go on Friday? Down.
Yes, that's right. Could go down. The chart could look like this. Now, do you think it's useful to know when that's about to happen?
Yes.
Yeah, that's kind of the whole point. Had you been on the trade on Tuesday morning, And by the way, you're going to be learning the same strategies that I use every day. So the same technical setups I look at, you're going to have this. I'll show you how it works. So let's say there's a good buying opportunity on Tuesday morning because there's a good technical setup. Now, on Thursday, my analyst... Firstly, we need to search for the list of currencies on the left-hand side here, one by one, until we eventually find a trading opportunity on the chart. Now, this could take around 15 minutes, but to save time here, I've already gone through the list and I found us a great income wave setup on pound versus dollar. Now, we want our buy entry at the top of this bar and the stop loss at the bottom. So the first thing we need to know are the values of the high and the low of this bar here. Now, to get this information, we simply hover our cursor over it, and now you can see the information I need highlighted at the bottom of the screen. The high of the bar is 1.32125, and the low of the bar is 1.31905. So our buy entry level is going to be the same as the high, and the stop loss level is going to be the same as the low. We only count to 4 decimal places on dollar-based pairs. We can see there is 22 pips between the buy entry and the stop loss. We're going to make this a 1-to-1, therefore our take profit will need to be 22 pips above the buy entry, so add 22 pips to 1.32125 and you get 1.32345. Okay, so we've got our buy entry, take profit and stop loss levels. We now need to work out our risk size for the trade. The risk management calculation is 2% of our account divided by the number of pips at risk. That's 2% of the £50,000 account size is going to be £1,000 of risk on the trade. However, you can't just put in £1,000 of risk into the software. We must enter the number of pounds we want to risk per pip. To work this out, we divide £1,000 by 22 pips. We have 1,000 divided by the 22 pips. That's going to be £45 and 45 pence per pip. Okay, so we now have our buy entry, stop loss, take profit levels, and our risk, which is £45 and 45 pence per pip. Now we're going to go to trading, choose new order. We're going to copy the information on the left into the order ticket. First, it's a pending order. Now the broker needs volume or risk size amounts to the nearest 10p, so instead of £45 and 45 pence per pip, I need to round it down to £45 and 40 pence here. I'll quickly input the buy entry level in here, and then my stop loss and take profit in here. It's an income wave trading opportunity. I can now go ahead and click on the place order button, and the order's been placed. It's been successful. Here is the buy entry, here is the stop loss, and here is the take profit. As you can see, the price eventually moved in our favour, and this trade was a winner. Thank you for watching, and I hope you found this demonstration interesting. Okay, nice. A nice little trade to show you that. Now, was that a nice, easy trade to follow? Let's see what you think. Yeah, a lot of numbers, and that was only a few of the steps, which is why, by the way, we do it together, which also suits most people's learning style. Some people are visual learners, they really understand when they see things. Some people are auditory learners, they need to really hear it. And some people are kinesthetic learners. They're the ones that actually need to be shown exactly and actually how to do it. That's certainly me, for example. So once you sit next to me and you show me what to do, I can do it. How many of you are the same? Lots of exclamation marks. Yeah, well, especially when it comes to practical things. That's why from today, when you participate in the trading challenge I mentioned earlier, each of you will be assigned one of my traders to be your one-to-one mentor. So you can have a look at the third blue arrow. Look at the bar again, just to the left of it. Do they all look like a familiar shape? Yeah, I'm getting lots of yeses. Yeah, it does. So every time certain patterns are found, Smart Charts flags it to our attention so we can go straight to that moment of interest. How cool is that? And also, by the way, you'll see, so you don't have to waste time looking at stuff that's just not happening. That's the most important thing. It's saving you a lot of grunt time by highlighting the opportunities so you don't have to go scouring for them. And you'll also notice a blue, a red, and a green dot. Now, what do you think the blue, the red, and the green dot mean?
Peter's on it very quickly. Yes, entry, stop and target. That's exactly right. The blue dot shows you where you could enter. The red dot shows you where you would put your stop loss. And the green dot shows you where you can take your profit. And they're all different in size because it's also done on all the risk-reward calculations based on the range size and so on. So please write this down. Every single trade is different to the next. And the reason why the distances are different between the stop loss, for example, and the entry price, is because Smart Charts has an algorithm built into it, dollars, throughout the world every single day. To put it into context, the UK...
when the green bar is low,
gross production is about $2
that
trillion.
means
The currency market
it's going to go down.
3 times that
When the pound goes up,
single day. That's a lot of
it
money.
means the US dollar's going down. You want to buy the pound.
To move that in
When the
large
US dollar's
chunks
going
are
up,
certainly not private investors or
it means the pound's going down.
large banks.
When the US dollar's going up, you want to buy it.
Large quantities is the interbank market.
When the US dollar's going up, it means the pound's going down.
How the large banks have obviously made some very large transactions in a very short space of time, and that's useful information for us, and it forms the basis of the first structure of our great topic. So when the price is gradual, for example, falling and it's falling and it's falling, but then reverses and goes all the way back up to where it started, that's not random. That's the banks getting in. This is what we call a T-wave buying pattern. It's called a T-wave buying pattern.
T.
Now this is an example.
Looks similar to a letter T.
One of the patterns. There are 10 different patterns that I look at. Now they're all very different shapes, sizes, colours. Some are complex, some are easy to look at, but they're all very different. They're all based on certain behavioural elements in the market between interactions between institutions, buyers and sellers, and they all represent unique opportunities. So, I guess let me ask you a question. Do you think it would be quite useful if there's a piece of software that could be programmed to find these patterns based on parameters that we can program into the software's filters to actually find these opportunities and then flag them to us in a visual way? Do you think that would be quite useful? Yeah, exactly. You're all saying it. It would be very useful. Just keep that thought in the back of your mind for a minute.
So when the bank's not
Now let's
getting...
talk about this T-wave. Now for those of you who I'm taking on to this Lifestyle Trader Challenge, this
Thank
is
you.
one strategy I want you to absolutely nail. So we're going to spend a lot of time concentrating on how the strategy works. As you know, there's quite a few steps involved in the strategy. It does take a good 2.5, even 3 hours to actually teach this strategy in its entirety. And obviously, I don't have enough time today to go through everything, but we're going to do that on the actual training itself. So I know some of you will be doing the training in about a week or two's time. Some of you are on already. Some of you will be doing that in a few weeks, but what I'm going to do later on is I'm going to show you some dates, and you can choose which one you want to do. We're going to go through everything in a lot of detail on those actual dates themselves. Okay. So now, basically, markets are like people. Okay, they breathe. Markets breathe out and they breathe in. They breathe out and they breathe in. They breathe out and they breathe in. We call this cyclicity. Now, we're in an uptrend here, okay, and we're looking mainly for buying opportunities. We would have traded with the momentum when we're trading with the banks, not against them. Don't swim head on against the current. Want to be with the momentum. Now, seeing as we're looking for buying opportunities, please tell me, looking at this, when do you think would be the right time to get into the trend? Look at the two numbers. Would it be position number 1 or would it be position number 2? Remember, we're looking for buying opportunities. We're looking to take advantage of an upwards movement. So when do you think would be the best time to enter the trade? Okay, majority of you are saying 1, a few 2s. Okay, look, obviously the position, obviously position number 1 is the answer we're looking for. Now, ideally, we'd love to get in at the bottom at number 1 and then get out at the top, which is number 2. We'd love to re-enter at the turning point 1 and get out at number 2. We'd love to get back in at the bottom and get back out at the top at number 2. However, how many of you think that is a realistic thing to actually try and do?
obviously not. But what we can do with the T-wave is we get in at number one, and then we can get out and grab a little bite at the market. We can get in at number one, and we can get out like a little 30 pips. We can get in at number one, get out and take a little chunk out of the market. And that is what we can do, okay? So how many of you are looking to just take regular bites out of the market, day in, day out? How many of you would be okay with that? Okay, good. How many of you wouldn't be too disappointed that you never got out right at the top? How many would you be okay with that? That's that question box. Great, okay, good. That shows me I'm actually speaking to a very rational group of people there, because guess what? And you know what? You're never going to get out at the top. When you realise that, you can actually start doing this properly. There's no point trying to chase what I would call an unreachable goal. Does that make sense? Now, when do you think, given what I've said, when most amateurs get in? Yeah, the word I'm seeing from about 60 of you, at least it must be, is at the top. That's exactly right. They always do that, don't they? Amateurs always get in near the top. That's right. It's because they don't know what they're doing. They're self-educated. You know what? They take too long to make a decision. They're not informed. So what they do is they sit there just watching the chart and they wait to see it move up first. That's the problem. And then when they see it move up, they start thinking, well, okay, it looks like it's going up, but I just want to be really sure, so I'm going to wait a little bit longer and see if it will go up a little bit more. And so I'll wait a little bit and a little bit longer. And then when I see it go up, I'm thinking, okay, it's definitely going up. I think I'll get in now. And they're getting in about 3/4 of the way to the top. 3 days later, they're lost. And they'll repeat that same pattern, interestingly enough, over and over. My favourite time to trade is between the hours of 6 in the morning and 8 o'clock in the morning. That's UK time, generally GMT time. It's my favourite time of the day for trading. I wake up just after 5 o'clock every day. I do the usual Facebook, grab a shower, as we all do, and then I get myself ready for about a 6 o'clock start, sometimes a little bit before that, but normally about around the 6 o'clock mark. Let me ask you guys, how many of you are available between 6 and 8 o'clock in the morning, or could be prepared to give it that time? Because that is the action time. Let's have a little look. Someone's like, no way. But most of you are saying, well, yeah, pretty much the vast majority of you are saying, yes, that's the magic time. And that's a lot of you, so we can do it together. And by the way, why do you think traders love trading first thing in the morning? Well, there's a pattern. There's really a pattern here, isn't it? Wealthy people tend to get up early in the morning. Why do traders love trading first thing in the morning? You got it, John. That's right. It's the European session. It's the start of the European session. So European countries are waking up. They're obviously an hour ahead of us. We're fresh and alert as well. And also, it's a good time to be productive. How many of you liked the idea, or how many would you like the idea of being done and dusted by 7:30, 7:45 in the morning, and then have the rest of the day to yourself? Bring it on, says Joe. Yeah, exactly. It's not a bad way to organise your day. You can finish trading, go continue on your working day, or run the businesses that you run, and you can get your productiveness done in the morning and then carry on with your business day. It's just a nice time to be productive, and it's when the banks are in, and it's where the volatility is, and it's where the movement of the market is. Now, how many of you are not available between the hours of 6 and 8 o'clock in the morning? Okay. So for those of you who are not available, there's a few of you aren't actually, there are 5 other times of the day that are good to trade. They're quite specific times of the day, and there's quite a few things we need to elaborate on regarding those times. But we're going to do that in greater detail on the trading itself. But if you're not available in the morning, don't worry. We're going to design something that you can use as well. So what we're looking for at certain times of the day is certain formations, certain shapes. Now here's the good news for you. You don't have to find these shapes or these formations yourself. The tool I use to find these setups and the shapes or the formations, for me, is called Smart Charts. It's used by thousands, literally thousands of Learn to Trade graduates and professional traders alike around the world. Smart Charts has a recognition tool built into it. It's based on algorithms
that we've refined and tested for many years, which have been programmed in to do really a lot of the donkey work. It's an amazing tool, and I'll show you a little bit how it works later on, but essentially it flags things to us. So at certain times of the day, certain events occur. Now, one thing that you're going to want to learn, and please write this down, is that when is the optimum time to put your entry point, to place your entry? At what point should you enter the market? Because timing is key. Please write that down. The entry point is crucial and critical. And where do you put that? Well, we're going to go through that on the training itself based on the various patterns and the various formations that we're going to be targeting. Another thing that you're going to want to learn about is where to put your stop loss. So there's the entry price where you get in, and that is specific and it's time-based. The stop loss is an automatic safety net in case it goes the other way, in case the position doesn't go the way you want it to go. You can think of that like an automatic emergency cut-off so you don't take further losses. And here's the thing, the stop loss shouldn't be too close to your entry either. It shouldn't be too far away either, and that's a mistake that a lot of amateurs make. Placement of the stop loss is obviously critical. There's an optimum distance where that stop loss should be, and that's based on certain currency pairs. We'll spend a lot of time and energy finding out what the perfect sweet spot for those currencies is. We're going to be sharing that with you. We'll go into that in a lot of detail on the training. Another thing that you're going to learn is how to take a profit and where the optimum profit level is. That's where we're exiting the trade and then we're cashing out and then we're banking the profit. Now, at certain times throughout the day, there are certain events that happen in the markets because of things that are happening in the real world. And you can learn exactly when is a good time to put your entry timing, how to protect yourself for maximum capital preservation, also where to put your exit and take profit level. Now, by the way, how many of you so far are finding this quite interesting? Let me have a quick look. Oh, that's very sweet, Jimmy. Thank you. Lots of big hearts and love. Thank you very much. I think this is really fascinating. And also, please let me know, has anyone ever shown you how to trade in this type of fashion or format before? Adrian, thank you for the mega comment. I really appreciate that. Well, look, for most people, it's a no, because this is the professional way. The only way you'll know how to do it is to be taught by a professional trader. I hope that makes sense. The only way you're actually going to grasp this is when you have an experienced, properly trained trader who's showing you what to do. Because, look, a book is not going to do that. A book is just theory. You read it, but it doesn't give you the approach. And then when you watch a video, and yes, you can get some great information. The only thing about a video is you're missing the all-important, what I think is all-important feedback. It's good to watch, but what do I do now? A video can't tell you if what you just did was right or wrong. The only way to actually learn this, like I did all those years ago, sitting on trading floors around the world, is when you're with a trader in the market, being shown in context to what's happening now. That's when we do this, and then when we do that, when we do this, and that's how we learn, because we're doing it in context, to the live market. That's how I learn. With real traders on real trading floor where trillions moved every day. It's very, very important to learn something in context because you see how it's in reference to the environment it's in. Now, the lovely thing here is that once we set the trade up, you can then close your laptop and carry on with the rest of your day, because once the price hits the targets, it will automatically close the trade. So the target is automated, and so is your stop loss as well. So once we set the trade up, we can and should, by the way, walk away and take advantage of that burst of movement. The next day, same process. We set up a trade.
So when the both the open and closing bars at the top to buy, it looks similar to a letter T. That's the sign. That's a sign that they're going to go up. However, when you see the opposite of that, when both the opening and closing green sticks are at the bottom, it means it's going down. But if you see the T sign, it's like a long letter T, similar to a letter T. It means it's going up. If you see that upside down, like the open and close signs near the bottom, it means it's going down. If one currency goes up, the other goes down. You put your money on the currencies that are going up, you win.